Chinese officials are stepping on the gas. This was stated by Frederick Human from HSBC. This is following China's interest rate cut by 0.25%, this being the sixth interest rate cut this year. Welcome back to Jugoscopy TV. Joining me for this week's weekly wrap-up is Brian Lawson, Global Economic and Financial Consultant at IHS. So Brian, it has been described that the joint moves on interest rates and the reserve requirement ratio shows that Beijing is determined to get the car out of the mud and get things moving again. Are we starting to see China's economy stabilise?
What we're really looking at is a classic counter-cyclical move by a government that's very keen indeed to avoid a hard landing for the Chinese economy. China has been slowing steadily and fairly consistently during the course of this year and has potentially worse numbers coming up in the fourth quarter when the impact on investment from the stock market volatility will start to show through. And basically what China is fighting is that sizable parts of its economy, particularly those in heavier industry, are now facing really quite slow growth by historical standards. For example, the Q3 data showed industry to be growing at just 5.9% year on year. And within that, there are some very painful areas. One example being the steel sector, where China is planning over the next few years to undertake a major restructuring of a heavily oversupplied sector to get the number of firms in that market down dramatically from its current level. And it faced a challenge this week from a state-owned enterprise unable to make payments on some yuan 2 billion of debt. That's the second state-owned company which has had debt service problems in the course of this year. We do think eventually that some form of restructuring will be found to avoid them actually going into default. But it illustrates there are some real problems. The move today, as you mentioned earlier, is one of a number of rate cuts this year. It's the classic response to a weak economy. Overall, our forecast for China this year is one of 6.5% growth. We see that further weakening next year to around 6.3%, and really several years before China will get back to the sort of levels it achieved in 2014. And even then, now officially coming through from state media, the story seems very much that it won't be going back to the sort of double-digit, dramatic growth phase that we enjoyed in the previous cycle. So all of this points to China being in a slowdown, taking measures to avoid that becoming excessively rapid, but still remaining with quite significant problems ahead.
Now looking at the US, Thursday's upbeat housing and labour market reports could keep a door open to an interest rate hike from the Federal Reserve by the end of the year. Next week brings one of the final FOMC rate decisions for 2015. Would you say the US is ready for a rate hike?
Overall, we continue to see the Fed's policy as quite finely balanced. The September employment report showed only 142,000 new jobs being created, which was some way below expectations. And although the home sales numbers and house prices data have been strong, leading indicators came out with a minus 0.2 number in September, the first decline since February. And in this context, we see the next two monthly employment reports as crucial. If October and November are strong, a December rate hike is our most likely scenario. But if they were less favourable and we see further weakening in the employment market, then there is a likelihood that the change would come early next year instead.
The Ukraine and Russia conflict seems to have progressed this week. S&P raised Ukraine's credit rating after seeing progress on reform debt. Kiev's 12-month outlook has also been described as stable, with the economy set for a 2% GDP growth in 2016. How would you describe Ukraine's economy at present?
I think it's important to look firstly at the technicalities of the Standard & Poor's move. When a country enforces change in its debt, it's moved to the status of technical default. But once it then agrees a restructuring of the debt, it is almost automatic that it will be upgraded. And that's just a mechanical way that rating agencies move their scores according to the state of play of renegotiation. So there's been no fundamental change in Ukraine's economy, S&P's change is a technical one, reflecting that the bondholders of existing sovereign debt, barring Russia, voted in favor of the proposed write-downs, which Ukraine agreed with its creditors previously. Overall, there are still quite significant problems in the Ukraine. Firstly, Russia's bond, the $3 billion that matures in late December, has not been sorted out. That's remaining unresolved, with Russia demanding full payment, treating it as official debt, with Ukraine saying that it's an international bond issue and therefore should fit into the overall rescheduling. And even though in the near term the political situation appears to improve and there has been a lightening of actual military conflict in recent days, those risks remain very high, and we don't see any real fundamental change in the embedded configuration in the country. We're not convinced that Ukraine necessarily will meet a positive growth figure in 2016, and to the extent that it does deviate from the path that it set out with the IMF for economic recovery, there could be quite significant perils ahead, including even the need for further debt renegotiation if there were some significant deviations from its economic path.
Well, Brian, thank you for your insight today. And viewers, thank you for watching. Be sure to click back on Monday, where all the leading financial news will be covered by the Dukascopy TV team. Goodbye for now.